and PNB. The PSU banks continue to do well.
Oh, yes, they do. So let's get stock specific now. Equitas Small Finance Bank is in focus. The MD and CEO of the bank has shelved his retirement plans and has decided to continue at the helm of the company. To tell us more about this decision and what business is likely to look like going ahead for the company, we are now joined by the man himself, N Vasudevan, the MD and CEO at Equitas Small Finance Bank. Mr. Vasudevan, good morning. Thank you so much for joining us here. Well, the first question really is, what made you change this decision and stay back? Were there difficulties finding a successor? Did something else happen?
Yeah, good morning. So, in the month of May, I had expressed my desire to step down, basically because I wanted to do some activities to create a corpus for our trust where we do a lot of activities. We had formed a search committee, and the search committee was on the job. But parallelly, the chairman and me, we were also discussing for the last couple of months or so, and we were discussing all kind of options and possibilities. And finally, we both concluded that, under the circumstance, maybe if I continue, that will be the best for all the stakeholders. And so that's where the decision really came from. And so that's where we kind of changed that decision. And I kind of withdrew my desire to step down, and so that's where we are.
Could you explain to us what those circumstances were? Mr. Vasudevan, you said you've been talking to the chairman, and you said that under certain circumstances, it is best that you stay put. Did you find any difficulty in finding a worthy successor? And what happens to your plans for, philanthropy, etc.?
Yeah, so the search process was on, so that was going on parallelly, and but we were discussing, simultaneously between me and the chairman, and there's a lot of things which are happening in Equitas, and that we are the Equitas platform is kind of built very strongly over the last few years, and hopefully the merger of the holding company should happen anytime soon, and potentially after that we could end up applying for the universal bank license. And, typically an NBOC converting into a bank, it's a 10-year journey for the NBOC converted bank to become a fully, efficient bank from a cost of funds perspective. And we are now about 5 and 6 years old as a bank. So we are really talking another 5 or 6 years by which the transformation into a bank would be fully complete, and the full benefit of conversion into a bank would be clearly visible. And so under the circumstance, the chairman was saying that can we not work on some alternate models for the.
Okay, we get that point. So that makes you a stable head, but you have been your term has been renewed for a further period of 3 years, with effect from July 23rd, 2023. So the question to be asked is that, will you stay for the entire 3 years, or will you stay only till the time all these circumstances are there? I mean, is there a possibility that you announce your retirement before the completion of these 3 years?
No, I think this decision is very clear and firm, and so if RBI approves it, then not only that I'll continue for this 3-year term that the board has recommended, but as per RBI guidelines, we have a 15-year timeline for a person to be the MD CEO of a bank. I have completed 6 years, and so I have another 8.5 plus years to go. So, God willing and subject to RBI approval, I think our decision is clear that I will continue till, we continue to have that RBI approval in place, and I complete the full 15 years.
Okay, so investors will be happy to know that the stock was buzzing yesterday, and everyone's calling it a positive move as well. In that case, Mr. Vasudevan, now that you're talking about being at the helm for a longer period of time, will loan growth for you be faster than system or below the system loan growth? You had cut down your guidance in terms of loan growth in the quarter gone by, and you are a cautious lender. Will you participate in the ongoing strong loan growth that we are seeing in the system?
Yeah, I mean, you really hit the nail on the head when you said we are a cautious lender. We continue to be very cautious, and we never want to do something which we kind of have to step back later. But we had initially estimated a 30% credit growth for the full year, and that was based on some kind of staffing plan in non-TN states, and that took about 3-4 months of delay. There was in terms of our recruitment and putting people in place, but that was a very short setback that we had 3-4 months. And so we did do a 20% growth for the first 6 months, but we are clear that the full year will be definitely 25% plus. But that is only for the year. And looking at the kind of segment where we lend and the kind of unmet demand that we have in those segments, historically we have grown at 30 to 35, and I think for the next foreseeable future, we should continue to aim around that level of growth. 25 to 30% is something that I think we should consistently aim going forward also.
Okay, 25 to 30% you should consistently aim, and the long-term target being 30 to 35%, which is the historical growth rate. We spoke with the management of Shriram Finance yesterday, and they did say that CV financing is facing a bit of an issue, especially on the first time on new CVs, etc., primarily because of cost of ownership increasing. Your view on that? And you did allude to growth of small business loans and segments outside of Tamil Nadu. How are those verticals growing for you? CV finance and businesses outside Tamil Nadu?
See, in commercial vehicles, we have a fairly even spread of used commercial vehicles and new commercial vehicles. Plus the fact that we are not very strong in the heavy commercial vehicle segment. We are very strong in the small commercial and the light commercial vehicle segment. We are not much present in the heavy commercial. And we, from our perspective, our portfolio has been actually doing very well in the current financial year. The NPS have actually been coming down. Recoveries are very strong in the commercial vehicle. And so for us, from our experience, our CV should continue to do very well. In fact, this year also CV portfolio should grow at the 25 plus percent even for the current year. So we are very comfortable from our side. And if you look at the overall industry also, the trend of commercial vehicle sales has been going up, and that is reflected in the used commercial market also. Of course, what you mentioned is right, that the cost of ownership has gone up because of the change in the emission norms and things like that. But that is some time back, and it's kind of got absorbed by the system. Now the freight rates have adjusted to that. And diesel prices, has been remaining reasonably within a small range. So overall, the fleet operators and the small operators are having a reasonably good time, and that's reflected in our performance of the portfolio also. As for the small business loan, that's our flagship program, and it's about 38-40% of our loan book is small business secured by their house property. And recently, we introduced a merchant OD product for them, where we give a OD along with a term loan, and that's really seen a very strong offtake. And so we are very bullish on the small business loan, which continues to be the flagship program for the bank.
Okay, so small business loans and the CV segment both doing well for you. I wanted to check on your OPEX as well, because that has been increasing because of expansion plans of the network. There's employee additions as well. What would the normalized number be? When will growth start coming in, business start ramping up? And the normalized level would be what? 63% was the guidance for FY23. What is the normalized level looking like as far as the OPEX is concerned?
See, as far as our cost to income ratio is concerned for Equitas, it will always be a little on the elevated side, fundamentally because we are a fixed cost model bank. We do not have, we don't source through agencies. Our DSA sourcing of the business is less than at the bank level. I think our DSA sourcing is less than 2-3%. 97-98% of all the loans we disburse are sourced directly by our own staff. And on the collections, we employ no agencies at all. Entire collection is handled by bank staff themselves. So you can imagine that it's a kind of a fixed cost model, so our cost income will always remain a little on the higher side. But as far as on an ongoing basis is concerned, yes, 25-30% growth will ensure that our cost to income remains at a reasonable level. But we'll also be parallelly investing, because we are investing in our network, and then on the field staff in terms of sales people from different verticals. Plus, we have a lot of products which are not running in all the branches. So as we expand the products into more and more branches, that will again take more field staff in those branches. And our investment in IT continues to be very strong, because we do have some advantage on the IT side as of now, and that's something we want to maintain going forward. So we will continuously be on an investment basis from the bank side, and on an ongoing basis, my feeling is in the near term, a cost income less than 60 is not likely. I think a 60% is more or less like our normalized thing, which will ensure that we are able to generate a fairly good return on the equity, but at the same time enable the bank to invest for the future.
Right. So 300 basis points further improvement is what you can see in your cost to income ratios from 63 to around 60% odd. You said that you don't employ any other collection agencies, etc. I just wanted to know your thoughts on asset quality. You have a restructured book of almost 1,000 odd crores. How much of that can slip in the second half? You had a guidance of 1.5% for credit cost. I mean, do you think that is achievable?
Yeah, so our restructured book was 9.5% when we started restructuring last year in December 21. Today it is under 5%, it's around 4.5%, and it will obviously go further down over the next 2, 3, 4 quarters. It will keep going down, and most of what should go wrong from restructured book has gone wrong, so we don't expect too much of worsening from that book again. In terms of credit cost, first quarter we had a 2.6% credit cost. Second quarter was 1.6%, and we have given a guidance of 1.5% credit cost for the full year, and we are very much on track to that, and we stick to that guideline, and I think for the year we should ensure that overall our credit cost remains at that 1.5% level.
Okay, so Mr. Vasudevan, last question before we let you go. What's the update on the timeline for the amalgamation with Equitas Holdings?
We had the final NCLT hearing on 21st of December. All the documents have been submitted, all approvals are in place. So the judgment is awaited now. So obviously there is no timeline fixed by the court, but we are hopeful that sometime by end Jan we should get the final order.
Right, by end Jan, a final order you get in, and all that is enough clarification. Thanks a lot, Mr. Vasudevan, for joining in. Wish you good luck for another stint at the helm of Equitas Small Finance Bank, and hope by the end of these 3 years you will be wealthier with the options that you have in the company to actually go ahead and make a big difference to society with the philanthropy plans that you had. Thank you, Mr. Vasudevan, for joining in. With that, we will slip into a short break. On the other side, we'll be joined by Aditya Agarwala to discuss the market technicals. Stay tuned.